So fear is creeping back into everyone's minds after some pretty bad economic data has just come out. And the stock market is off 3 consecutive weeks of declines, and we are seeing that in the real estate market, stock market, and even the used car market. So today, we're going to talk about what the Federal Reserve has said in their recent meeting and what their upcoming decision means for the economy, real estate, and stocks. And we'll also answer the question, are we headed into a recession? So first, it's important to understand that the Fed's job is to set interest rates to keep inflation down. And this is important because if inflation is too high, the cost of living will rise and people will be unable to afford the same things they once used to. So what did the Fed say in their recent meeting? Well, so Treasury yields have risen, and this is significant because it's essentially telling us what the market thinks interest rates will be at that time period. So if the 1-year Treasury yield has risen by 5%, which means the market expects the Fed's interest rate to be 5% in 1 year, and that's exactly what's happening. And currently, the Fed rate is at 4.75%, so basically the market is expecting one more rate increase to 5%. But I hate to say it, a storm is brewing. See, the Wall Street Journal has pointed out that investors are bracing for a volatile market by buying an enormous amount of call options on the volatility index. This means that investors think there could be some wild stock movements coming, and these large movements are usually to the downside. So why are investors so concerned? Well, it comes because of what Fed said in their recent Fed Minutes meeting. See, the Fed said that they expect rates to rise by 25% again, which has been unanimous in their meetings until now. This is what's important. See, now there are some members that say we need rate increases of 50 points instead of 25, which would be a way more aggressive rate than anyone has been prepared for. And that's because inflation was coming down, but now it seems to be stickier than we expected. And the Fed is looking for drops in 3 different categories in order to know if their interest rate raising is working. If they don't see drops in those categories, then they will need to make more aggressive interest rates to keep inflation under control, which is exactly what's happening right now. These 3 categories that are looking for drops in housing, consumer goods, and employment. And the housing market has been coming down with interest rates, so that has worked. But consumer goods were coming down, but in January, the U.S. spending rose by 1.8%, which is actually really bad news. And on top of that, the U.S. economy added 500,000 new jobs, and unemployment is at historic lows. And guys, this is really bad news, which means that the Fed's effort to slow the economy basically isn't working. In fact, the PCE report has inflation increasing by 0.6% in January, which is a huge miss, and inflation was supposed to be going down, and now we're actually seeing it going up again, which is again bad news. So investors are scared that the Fed will be forced to make larger than expected interest rate increases to get inflation under control. And they have a ton of work to do if they want to get interest rates under control and get back to the inflation at 2%. Like probably years of work. What does this mean for the economy? So the Federal Reserve, or known as the Fed, has been keeping interest rates low to stimulate the economy. But if they have to increase rates more than expected, it could force the US into a recession. And unfortunately, the chance of that is higher than we thought just a couple months ago. Because just recently, we added 500,000 new jobs, which is the opposite of what the Fed wanted to see. So it looks like the Fed might even have to introduce more aggressive rates than we currently are sitting at right now. And this could put us into 3 different scenarios. The first scenario is disinflation or no landing. This means that real GDP rises, but inflation continues to come down. And from the data that we're seeing, this is very unlikely. I think it's going to be a 60-40 split or percentage-wise between a soft landing and a hard landing. And the worst case scenario would be a hard landing, which is like a decent recession. Jobs would be lost and prices would fall. So this would accomplish the Fed's goal, but it wouldn't be pretty. Fortunately, what I think is a more likely situation right now is a soft landing. And as it sounds, it's a less drastic decline in GDP and job loss than what a hard landing would be. And ultimately, it gets the goal of inflation under control. And yes, it still is a recession, but it is the most ideal scenario. And it tends to be what most economists are thinking right now, which is pretty good news. Now, my little caveat is this is all under the assumption that we don't start seeing a wage price spiral and things getting way out of control. If that were to happen, the Fed would need to be very aggressive with rates, and that could put us into a bad recession. So I can't stress it enough, guys. Please be paying attention to what the Fed meeting says in March and just see where the whole economy is going. Or you can subscribe and I will be giving you the updates right here. Remember, staying informed and up to date on the latest economic developments could help you better make financial decisions for yourself and for your family. So let's start with the stock market. As you may have heard, the stocks have been under pressure due to the looming recession. In fact, last week was the worst week so far in 2023, and according to the Wall Street Journal, more call options on the volatility index have exchanged hands in February than any time since March of 2022. This means investors are predicting large movements in the market and buying hedges in case that happens. The reason for this uncertainty is that investors are worried about where the interest rates will peak. They thought the next upcoming meeting would be the last rate increase at 25 basis points, but some of the members who control the interest rates have said they favor a 50 basis point increase. And the market didn't like this because it wasn't what they expected. It means that more rate increases down the road might be on the table if inflation is getting worse than they thought. Lauren Goodwin, an economist from New York Life Investments, predicts that stocks will fall another 10 to 15%. However, I'm not sure about that prediction. In 2022, we saw a stock market crash where we saw S&P 500 down 20%. Okay, so we're already down a lot and the market has already been beaten and priced in a recession. After all, this is the most anticipated recession of all time, so it's pretty unlikely we crash again. What I think is more likely to happen is we'll see a slow recovery. Maybe it's choppy for the next 6 months, but once the Fed starts easing off interest rates, it will be buy time for the market, if not already right now. And to get ready for buy time, check out my link below. It's a Webull link. It's a free brokerage. It's a great spot to buy and sell stocks. And when you get an account with them, you can get up to 20 free shares of Google using the link below. And Google is $100 a share. So that's a pretty good deal. But anyway, it's time to move on to real estate. So at the beginning of the month, real estate saw buyers returning to the markets. And there was once hope again as rates started to come down again. But fortunately, that was short-lived as rates are once again headed back up. And these higher rates mean less people can afford to buy, but it also means less people can afford to sell since they're locked into their super low interest rates. And these higher interest rates are keeping people from both buying and from selling, which is why sales volume is so low. There are firms that are saying real estate prices will go up, but there are also firms that are saying real estate prices will go down. It looks like a wash for the most part as analysts don't really know what's going to happen. However, I think we're going to see housing prices come down, not like the 2008 style housing crash, but just come down a little more this year. After all, the housing market has already dropped in 2023, but we don't have an oversupply problem. We actually have a shortage. So without a bunch of volume, I don't see any crazy price movements coming. I do think we will see small drops due to the fact that new houses are still being added to the market, and the new homes are going to add some supply to the market. As interest rates will move up, less people will be able to afford homes, so they will be turning to renting, which unfortunately is why I think renting prices will still keep going up. And that's kind of my overall recap of what the Fed said. It is bad news, but it could be worse news, but it's really important to pay attention and see what the Fed is going to say. So for that upcoming March meeting, please stay tuned. If you think I earned that subscribe, it's very helpful to stay in tune and know what the Fed says. And I will be reporting on what the Fed says as well. I personally think it's not a bad time to buy stocks either, and use that link below for some free stocks coming your way. I really appreciate it. I don't make anything on these videos, so if you found it helpful, please hit that like button. It helps me out so much. And you have a great one.